He borrowed $20,000 and bought every MicroStrategy share he could. The gamble cost him his entire savings and could wipe him out. A tiny Jerky shop turned into a $20K loan that funded a high-risk crypto play. If you think your side hustle can finance a market-size bet, you might be wrong. Hundreds of Reddit users have copied this move, and many have watched their accounts evaporate. Understanding why this strategy is dangerous can protect your own portfolio. So how did a 20-year-old go from selling meat to betting on Bitcoin through a corporate stock? The rise of the Jerky entrepreneur. He started a beef jerky business in his dorm room. After costs, the venture earned about $11 per hour. The profit was modest, but the bank saw a pattern of steady cash flow. Within months, the bank offered a $20,000 overdraft line, assuming inventory purchases. He accepted the credit, closed the kitchen, and kept the overdraft open. The all-in decision instead of buying more meat. You read about Michael Saylor's Bitcoin purchases. Saylor's company, MicroStrategy, uses its stock as a levered Bitcoin exposure. The Redditor owned a small position in MSTR already at a high average cost. He sold his entire stock portfolio, liquidated the Jerky cash, and used the overdraft to buy 350 additional shares. His thesis: Bitcoin keeps absorbing capital. MSTR is the cheapest way to ride that wave. Warning signs ignored. First, the overdraft was unsecured, tied to a business that no longer existed. Second, MSTR trades at a massive discount to Bitcoin's market price, reflecting market skepticism. Third, the stock's volatility exceeds that of the underlying asset because of leverage. He dismissed these risks, saying, "The bank thinks I'm buying inventory." But the bank's loan terms required repayment regardless of stock performance. The turning point in early July 2026, Bitcoin slipped 15% in a single day. MSTR share price fell 30% as investors fled leveraged exposure. His $20,000 investment dropped to $14,000 overnight. The overdraft's interest accrued, increasing his debt to $22,500 within weeks. The collapse unfolds by August. The bank issued a notice: overdraft usage exceeds approved purpose. He could not reclassify the shares as inventory. The bank demanded repayment within 10 business days. He tried to sell a portion of his MSTR shares, but the market depth was thin. Selling pushed the price lower. He realized he could not cover the loan without locking in a loss. The Reddit thread exploded with replies: "Don't do this. You're bankrupt soon. Sell now." Aftermath and legal exposure. He filed a personal bankruptcy petition in September. The overdraft was classified as a personal liability, not a business expense. Creditors seized his remaining assets, including a modest crypto wallet. SEC filings later showed MicroStrategy's Bitcoin holdings had also dipped, confirming the systemic risk of leveraged bets. But it gets worse. Other users who copied the strategy faced margin calls from their brokers. Webull reported a 12% rise in forced liquidations linked to MSTR in Q3 2026. Here's what they missed. Leverage amplifies both upside and downside. A 30% stock drop translates to a 50% equity loss when financed. Overdrafts carry high interest rates, often above 12% APR, eroding any potential gains. Regulators consider such financing misuse of business credit, which can trigger investigations. That was the easy part. The emotional toll was severe. He posted an apology on Reddit, admitting he thought he was smarter than the market. Friends who invested alongside him lost their savings too, and then the bank noticed. The bank closed his overdraft line permanently, flagging his account for fraud. His credit score plummeted below 500, making future borrowing impossible. The final blow came when MicroStrategy announced a new Bitcoin purchase funded by a $1 billion convertible bond. The stock's price surged temporarily, but the surge was short-lived. He missed the rally because his shares were already pledged as collateral. The lesson is clear. A $20,000 overdraft is not a free ticket to a crypto jackpot. Leverage without a solid repayment plan invites disaster. So what can we take away from this reckless bet? Lesson 1. Never finance speculative investments with business credit meant for operations. Lesson 2. Understand the mechanics of leveraged stocks. Discounts to underlying assets signal risk, not value. Lesson 3. Keep a cash reserve to meet loan obligations regardless of market moves. The people involved didn't set out to fail. They believed in a grand thesis and ignored basic risk management. The difference between them and you is awareness, and that's why you're here. If today's story made you reconsider how you fund risky bets, check out Webble. You can trade commission-free for 90 days, and the platform offers tools to monitor margin and loan exposure. It won't protect you from every mistake, but it's a start. Want more deep dives into the biggest financial disasters? Hit subscribe. We publish a new breakdown every week, and you won't want to miss the next one. Criminal or just reckless? Tell me below. Save this video so you don't forget the warning.